So let me ask you a question. When an economy is facing inflation, is facing unemployment, or even slow growth, who do you think should fix it? Do you think it's the federal government or is it the central bank? The answer actually is both. They do this through fiscal policy and through monetary policy. In this video, short video, I'm going to be explaining to you the difference between them and also how they actually use their policies to regulate what happens in the economy. So let's start with fiscal policy, right? So when you talk of fiscal policy simply refers to the use of government spending and taxation to actually influence the economy. In simple terms, what we're saying is that the government can decide to increase or reduce spending and also taxes to control economic activities. And there are two major tools that they actually use. The first one is government spending. When the government spends more on infrastructure, on healthcare, education, what that does is that money actually flows out into the economy. And this actually creates jobs, stimulates economic growth, and there are activities here and there, including employment. The second way is actually through taxation. Now, when government reduces taxes, people and businesses actually have more money to spend and also to invest. But if taxes increase, spending may reduce, which can actually help also to control inflation. So remember this, that fiscal policy is controlled by government and implemented through the national budget. Now, let's move to monetary policy. Now, when you talk of monetary policy, all we're simply saying is that we're looking at the monetary authorities and how they actually influence the happening in the economy. And so this policy refers to the actions taken by central banks to control the supply of money and credit in the economy. In Nigeria, for instance, the responsibility belongs to the Central Bank of Nigeria. So the central bank mainly controls the economy through the interest rate and through the money supply. Now, one important tool, again, is the interest rate. Now, when interest rates are very, very high, what it means is that borrowing becomes very, very expensive. And so people and businesses borrow less, which will actually help to reduce inflation. So when interest rates are low, what is the implication? It means that borrowing becomes a bit cheaper and encouraging for businesses to invest and also consumers to spend more money. Now, the central bank may also decide to buy or sell government securities to control how much money is in circulation. The key difference between the monetary policy and the fiscal policy is that the fiscal policy is controlled by the federal government and they use taxation and also government spending, while monetary policy is controlled by the Central Bank of Nigeria and they use the interest rate and also money supply. So both policies actually aim at trying to stabilize the economy and also to promote economic growth. If you find this explanation helpful, kindly like, share, and also subscribe to our channel. Thank you for watching, and I'll see you again in my next video.